I'd like to welcome everyone to our June webinar, Improving Credit Operations Through Loan Process Review. We are expecting a great turnout today, and thank you all for participating in this webinar. I'll go ahead and begin with a brief overview on how this webinar will be run, and then I'll introduce our facilitator. My name is Jessica Alfaro, and I'm a manager at CapPlus Exchange. I'm very pleased to have met or communicated with several of you earlier and to meet the rest of you today. We have quite a few new people joining us today, and so for those who are joining for the first time, I'd like to just give you a little bit more background on CapPlus. CapPlus Exchange enables financial institutions in emerging markets to serve small businesses more effectively and profitably, and dedicated to increasing people's economic opportunities by strengthening financial services to small businesses. CapPlus provides financial institutions with strategic and operational capacity building, training and peer learning, and pilots of innovative solutions to expand markets. Specifically for this webinar, we have muted all voice lines going through to improve the sound quality, but we do encourage you to submit your questions and any comments by typing them into the chat box on the GoToWebinar app on the right-hand side of your screen. We will be asking for your input from the audience at a few points in the webinar, and we look forward to hearing your thoughts at those times. We will also record and post this video for those on our web community who've missed this webinar or any others who wish to access it again. I'd also like to just tell you a little bit about our upcoming events as well. CapPlus is proud to again be a partner of SME Finance Forum 2016, which is expected to bring together some 400 senior executives from commercial banks, development finance institutions, and fintech companies, as well as regulators. This event will highlight innovative SME banking approaches, showcase cutting-edge financial technologies, and address crucial policy and regulatory issues. You can see a little bit more about the event on this slide, and you can also get more information from our website. And we also have other webinars coming up. Our next webinar is Managing a Successful IT Conversion at Your Institution, and it will be held on Tuesday, July 26th. These are free and open to all participants in the SME ecosystem, and so we do encourage you to register for that as well. And you can register for either the Global SME Finance Forum 2016 or upcoming webinars at our website. I would now like to introduce you to our very experienced facilitator. Cecilia Deacon is a development banker specializing in credit risk management for micro and SME-oriented institutions with almost 30 years combined experience in mainstream banking and in MSME consultancy. Her microfinance consulting work started in 1999, and she has assisted more than 20 micro and SME-oriented financial institutions in Asia and Africa with remarkable successes in bank turnaround and in assisting startup microfinance operations. At this point in time, I will turn it over to Cecilia to take you through the webinar.
Thank you, Jessica, for the introduction, and welcome everybody to this webinar. I am Cecilia, and I'll be with you in the next hour for this webinar. Now, being in control of credit operations starts from knowing what works well and what needs to be improved. This is one of the key success factors of mature SME banks. On the other hand, one of the causes of failure of many financial institutions is late detection of problems in credit operations. There isn't much you can do even if you have all the resources when the magnitude of the problem gets out of hand. Now, how can we possibly achieve the former and avoid the latter? A periodic assessment of the state of your credit operations is necessary even before serious red flags appear. It is also necessary when preparing for business expansion. The assessment will help to identify aspects needing immediate special attention, issues that seem trivial but could potentially create serious problems if unresolved, and more importantly, knowing what good practices that boosts business can be replicated in current operations or future business expansion. In this webinar today, we will be walking you through an assessment process called loan process review. It is a methodical evaluation of the key aspects in lending. We will be presenting the processes, the outcomes, output and challenges, and most importantly, the experiences of some institutions that have undergone loan process review. Now, what do we want to achieve in this webinar? Now, we hope participants to understand the concepts of conducting the loan process review, the processes, and the areas that will be covered during the review. Some points about loan process review and its scope. A loan process review is a holistic review of all aspects of credit operations. In this webinar, the discussion will focus on the most essential aspects, like review of credit operation structure, efficiency and controls in the loan workflow, the quality of reports, and loan officer productivity and performance management. Loan process review is ideally done once in 3 years, but more frequently when planning for expansion or when experiencing operational difficulties. There is a common perception that loan process review is a duplication of the internal audit function. Actually, it is not. These two functions complement each other, though they differ in breadth and depth of coverage, specifically in reviewing credit operations. Loan process reviewers look at each client with the eyes of a loan appraiser or a credit analyst. They're like reappraising every single account that they review all over again. And as we said earlier, loan process review always goes with two objectives: identifying success factors and identifying red flags. We are equally interested in seeing what's behind the beautiful numbers and the not so beautiful numbers. Loan process review and audit are complementary functions. Now, the first question that people always ask is, who does the loan process review? Now, a very important rule is this: the person to do the loan process review should be an independent person with sound credit background who is not in any way involved in lending. Now, excuse me, why do we emphasize this? Now, for the reviewer to be objective, he or she should not be involved in the day-to-day lending operations. But it is important that the person should have a sound credit background because, as we said earlier, as a reviewer, he or she will have to look at every account that they review with the eyes of an appraiser or a credit analyst. So who could this person be? It could be somebody from the Enterprise Risk Management Department, or somebody under the Compliance Department, or an external person like a consultant. Now, these are the steps in conducting the loan process review. Now, the review follows a logical flow. We start the bigger picture, then we go down to the details. So first, we do a portfolio review. We examine the growth trend, the quality, and profitability. Then we review the structure, the manual, the loan processes, manpower turnover and performance, loan documentation, field validation, and at the end of all this, we conclude the review with preparation of the report and discussing the first draft with management before we come up with the final report. So we begin with the review of the loan portfolio. We examine the trends over a certain period of time, usually 3 years. We assess changes in the number of borrowers and loan portfolio outstanding, portfolio at risk by branch, loan product, and by loan officer. One of the things that we want to emphasize is that when we analyze portfolio quality, we do not only focus on the overall figures. We always examine PAR by branch, product, and loan officer. By doing this, the result will give indications of which branch, product, and loan officer are contributing most to the problem. The next step is reviewing the credit operation structure. What is the importance of reviewing the structure? Well, first, the review helps identify possible flaws that can affect operational efficiency, productivity, and controls. Reporting and supervision lines, hierarchy and authority, and the time and motion in transaction processing are affected by the way credit operations is being structured. We can also identify common functional overlaps between credit and business teams, or among the teams handling different products, and some operational issues like credit analysts losing objectivity because they're being supervised by branch managers. In fact, in one institution that I visited, for example, the credit manager could not vote against high-risk accounts because in the structure, he was directly reporting to the marketing director, whose main concern was targets. And to make things worse, the marketing director also had single loan approval authority. Now, problems such as these are the results of errors in the way credit operations is being structured. Moreover, when planning to decentralize approval authorities, credit operation structure should be re-evaluated and enhanced to reflect delegation of authority. After reviewing the credit operation structure, we then review the loan policies and procedures manual. The manual is the main guiding document for everybody involved in lending, and Central Bank always requires financial institutions to have one. This is the source of guidance for every person involved in lending. It contains the rules and the procedures in origination, underwriting, approval, closing, disbursement, and monitoring. All banks that I have visited have one, but in most cases, these are not being used. The manual is always the first thing that I ask for whenever I visit branches. But it makes me scratch my head when somebody gives me one that is full of dust. Or worse, if managers are unable to locate where the manual is. In most cases, manuals are not updated, or if they are, neither documented nor approved by the board. So how can we expect standardization in the implementation of policies and procedures across branches without a well-updated and functional manual? The bank where I worked many years back used to run written tests, sometimes oral tests, on policies and procedures relevant to one's position during performance appraisal review, and or seriously affected our performance rating. Management believed that that was the effective way of making people study the manual. Then in the next step of the review, we look at the loan process flow. There are two different important aspects in the process flow that reviewers need to check. These are efficiency and controls. One of the key drivers of customer satisfaction is the waiting time from the date they submit their loan application up to the time that they get the money. This concerns them more than interest rates. We all know that. In customer satisfaction surveys I've done, this is always the number one or the number two driver of customer satisfaction. We care very much about customer satisfaction. However, we also cannot afford to compromise controls. One of the cardinal principles in lending is that no one person should be allowed to process a loan from origination to disbursement. And this cardinal principle has to be reflected in the loan process flow. There has to be intervention by at least one independent person in the entire process. This is the reason why loan requests are reviewed by credit analysts, approval is done by credit committee, and disbursement is done either by finance personnel or the branches. In this step, the reviewers examine first whether there are unnecessary steps that can be eliminated to improve efficiency. And second, whether controls are well integrated into the loan process flow. Now, flaws in the process flow directly impacts loan turnaround time. Having a good balance of controls and efficiency is every banker's dream. The next aspect that we review is manpower, specifically performance and turnover. Two of the strongest success drivers in SME lending are staff productivity and staff retention. If these are messed up, things turn upside down. Some of the key things that reviewers examine are exit interview sheets, individual loan officers' performance trend, and performance appraisal review system. In this step, reviewers work closely with HR department head. Now, the weightiest part of the review is the loan document review. The condition of the loan documents tells the best and worst things happening in the lending operations. In this step, we find the answers to a lot of questions about the quality of the portfolio. The key things the reviewers check here are custody and upkeep of the files, completeness of documents in the file like application forms, documentation of loan appraisal, review and approval documents, copy of loan contracts, and copies of loan security documents. A significant amount of time is allocated to review loan appraisal and approval documents. Some of the common findings are shortcuts in loan appraisal. It is very common that loan officers are in a hurry to finish loan appraisal. They do bottom-up style in financial analysis. LOs determine the amortization of the loan amount that the customer wants to borrow. Then they make up financial figures going upwards to make it appear that the customer can afford to pay the loan amortization. This happens in many of the institutions I have visited. And of course, the outcome is always problem loans. Another common observation is the copying and pasting of the same financial analysis of the previous loan for the succeeding loans. We find identical financial analysis spreadsheets from the first to the third or fourth and fifth loans. Another common issue is unauthorized approval of large loans. For example, loans that are supposed to be approved by the board, sometimes, especially during reavailments, are just automatically disbursed, especially if the account is performing well. And you know, the repeat loan sometimes is not approved by the board, or if they are, the board approval document is not found in the loan file. Another issue is the non-compliance to loan approval or loan disbursement condition and the shortcuts in disbursement. During the review, we also evaluate loan reports. We assess whether the reports provide key information needed by the users. Are these easy to understand? Oftentimes, we find too many reports, but only one or two provide key information needed to manage the loan portfolio. After reviewing the loan documents, the reviewers start hitting the field. The main purpose of the field visit is to validate information that we find in the credit files. This step also tells a lot of stories about how numbers are being cooked. At the end of the review, Observations are discussed between the reviewers and the key officers. The first draft of the report is prepared after the discussion and sent to management for the written responses and plans to implement recommendations. After this, the reviewers prepare the final report, which is sent to senior management and internal audit. The CEO and internal audit discuss the report separately with the board and the board audit committee, respectively. Now you might ask, how many days does one cycle of loan process review take? Well, it depends on a lot of factors. First is the volume of loans to be reviewed. The management determine what percentage of the loans they want to be reviewed. Do they want 30%, 40%, or 50% of the loan portfolio? Another factor is the distance of the branches. Field visits take long if the review covers distant branches, and also availability of logistics in this case. But on average, one loan review cycle takes about 5 to 6 weeks. That includes preparation, actual review, and preparation of the report. Now, what are the outputs of the loan process review? Now, these are some of the examples. The analysis of portfolio, explaining possible causes of undesirable trends, and awareness of which branch, product, or loan officer contributes most of the problem. And also the best performing branch, the best performing product, and the loan officer. The things that are working well at present, which can be replicated immediately or in the planned business expansion. An analysis of other operational challenges and what's causing them, like high staff turnover, decreasing client retention, gaps in control that may cause fraud, and many others. The most important part of the report is the summary of recommendations to resolve pressing concerns, such as improving efficiency, controls, staff performance. Now, recommendations of external reviewers like consultants are based on best practices of other institutions that have succeeded in resolving similar issues. And finally, action plan by priority area that summarizes what steps are to be taken in order to address the issues that were identified by the reviewers. And the action plan also contains the point persons and the resource requirement. Well, as we said earlier, loan process review is an effective tool for proactive management of credit operations. It creates awareness of good practices presently done by the institution that can be rolled out to improve efficiency, productivity, and portfolio quality. It also creates awareness of practices that hinder portfolio growth, brings to light hidden problem loans, and most especially, it helps build a documentation of experiences and recommendations that will serve as good management reference in the future. Now, conducting loan process review is not without challenges. Now, these are the common challenges that we encounter. Lack of management buy-in and cooperative staff, limitations in resource allocation, finding the right timing, poor filing system, and inaccurate report. The designated reviewer prepares the plan and drives the conduct of the review. Actual implementation is mainly dependent on a lot of factors. Plans may change when confronted with challenges. The first challenge is setting the schedule. It becomes a challenge when there are several activities coming up in the bank, like audit, board meeting, availability of persons in the bank, like the head of credit, head of IT, and the CEO for the wrap-up discussion. Sometimes the review is interrupted when some important visitors come, like representatives of funders who will be meeting with the same persons needed in the review, or some unannounced visit of regulators. Conducting the review can be strenuous if there is lack of cooperation from staffs involved. It makes gathering information and accessing documents difficult, and it will affect the quality of the result. Efficiency of the review is affected by the way credit files and documents are kept. Locating one file, for example, or one document, which normally takes a couple of minutes, can take hours, especially if there is a big number of files to search from, if these are not properly maintained. Sometimes you find one document in this area, and then you go to another area, you pick up another document, and so on. So a very simple process can take long time if files or all documents are not properly kept. Moreover, quantitative analysis can be difficult and result becomes unreliable if the information in the loan reports are inaccurate. Finally, the ease of overcoming these challenges highly depends on management buy-in. If management is convinced that the review will be beneficial to the institution and the people running it, then all the challenges that we have talked about can be addressed and the review will go smoothly. In the next slides, we will be presenting some feedback from the institutions where we have conducted loan process review. Now, the Chief Credit Officer of a development bank in the Philippines said that through the loan process review, top management became aware of the inconsistent interpretation and implementation of some policies and procedures in the field. It had created confusion among branch staffs and some clients. Now, what happened in this institution was this: a new product was introduced. A briefing was done about the product features, policies and procedures, and product delivery, and with that, management assumed that things were clearly understood. Since the product was new, some changes were made in the requirements and in a couple of policies after the 3rd and 6 months of product implementation. And those changes were disseminated to the branches by the product was selling quite well in some branches, but not in most branches. The following year, after the product implementation, we conducted the loan review, and we found out that not all branches adopted the changes correctly. The gap was that after the changes were disseminated via memo, nobody went to the branches to do some checks as to how the changes were implemented, how the memo was interpreted. Some branches did not appreciate the changes and did not implement them at all. That created confusion among loan officers and clients who knew that requirements were different in other branches. Now, a CEO of an MFI in Rwanda said the findings in the loan process review answered a lot of questions related to stalled portfolio growth, high staff turnover, and it has also identified unnecessary steps in lending that has greatly affected customer satisfaction. Now, shortcuts in loan origination and underwriting resulted to high par. With the pressure to bring down par also came higher targets. Par continued to increase and productivity never increased despite the constant push. So tension in the institution was rising. Then loan officer turnover increased. One of the issues that the reviewers identified during the focus group discussion with the loan officers was the lack of support in recovering long overdue payments, like payments that were overdue for a year or more, which are almost impossible to recover. So most of the loan officers were spending 70% of their time chasing defaulters. 70%. Now, with only 30% of their time left to generate new loans, quality of underwriting suffered. Towards the end of, towards the last week of the month, they said that they just grab anybody who wanted the loan and they process the loan as fast as they can in order to come up with some new disbursement by month end. Now, with this, portfolio quality continuously declined. Now, as resignation increased, recruitment was done in a rush. Training and mentoring was no longer done properly, and shadowing was cut short, and new LOs were sent to the field very unprepared. They have been trapped in this cycle for a long time. When we conducted the review and brought all these issues to management and gave our recommendations, they were so happy. Now, another institution said this: the recommended streamlining of our loan processes will effectively cut down loan processing time by half. This, excuse me, as we are in the process of preparing strategies and business expansion. Now, in this case, the main concern raised by loan officers and branch managers was the loan turnaround time. It was taking them 3 weeks to process new small loans and a week to process repeat loans. What was mainly causing the delay was the several layers of field validation required before the loan request reaches the credit committee. Credit supervisors, branch managers, credit analysts were required to visit every single loan, both new and repeat. For larger loans, in fact, regional managers were also required to visit. So this process is very unproductive, and for both the client and the institution, it has been very time-consuming. Now, this has been raised by the loan officer, but there was no proper venue allowed for discussion of the pros and cons, especially the feedback of the clients in the field. Now, the reviewers interviewed customers, and almost 90% of those customers interviewed aired their concerns about this. In fact, in the exit survey, we also found the same reason as the number one or the number two reason why customers left. Now, the credit director of an MFI in Cameroon said that we came to know about the practice of an authorized waiver of charges and discounting of fees through the loan process review. And this happened because of the weaknesses in the IT system. Now, what happened here was it's actually a big fraud. Management was unaware that for quite some time, some managers were granting waiver of penalties, waiver of surcharges without any authorization. In the IT system, the user's access rights are defined as to what they can do and what they cannot do. Now, in this case, we discovered that some managers could actually grant waiver of charges. They can waive the charges and fees. So because of this weakness, which was not highlighted, they were given the chance or the opportunity to grant waivers and put the money in their pocket. So the credit director was very glad that this long-time practice has been finally out, and they were able to cut this practice. And of course, they're happy that a big chunk of the revenue that was going to the pockets of these people have gone to the bank already. Now, credit supervisors of an MFI in Nigeria told us that recommendations from the loan review helped convince management that centralizing disbursement of large loans was necessary. It has cut down the client's waiting time because the back and forth in funds requisition was eliminated. Now, we know that processing of disbursement, especially for large loans, is a big issue in many institutions. Now, because of the size of the loan, there are several steps that need to be done, like some documentations at the finance department. And funds requisition by the branches also has to go through a certain process. Now, the loan officers and the branch managers have long recommended that the disbursement process for large loans be changed. However, nobody was able to explain properly what the pros and cons are, and nobody have given them a concrete recommendation as to what could be the alternative way of disbursing large loans that will help improve the processing time without sacrificing controls. So with our recommendation, we have drawn the detailed process flow and the controls also that we have recommended. So they agreed that, in fact, centralizing disbursement of large loans will cut a large amount of time, because then, once the finance department receives the request, they have to process the disbursement right away. There was no more need of transferring funds from head office to the branches. So these are just some of the feedback that we have gathered from the field. I know that some of you might want to share later on some of your experiences. Thank you for your time.
Great.
So,
Thank you so much, Cecilia. We really appreciate that very, very excellent presentation. We're going to move into the discussion period now, and so I'd like to invite everyone to invite you to post any questions that you have or raise your hand. I'm also happy to unmute your microphone. Challenges that we're seeing in doing this, even though most of the institutions are saying that they can do it, have to do with some of the ones that you mentioned as well. So I think time is a very big issue, as well as the availability of data, and just getting started, not sure which team should do it as well, and lack of senior management buy-in. So maybe you could, as we're getting into the discussion period, Cecilia, you can share what would be some solutions to some of these challenges. And as Cecilia is sharing on that, please do continue to post your questions in the chat box, and we'll go ahead and get those out to Cecilia in the next couple minutes.
Okay, now what we always suggest is that initial discussions about the possibility of conducting a loan process review in an institution should always be done at the top management level. We believe that whatever is agreed upon at the top management level will be very easy to cascade down to the branches. Now, we make sure that top management appreciates the value of loan process review. They are committed to allocating the resources necessary. We understand what it takes, the demand in the time, and some of the people who will be involved in the loan process review. Now, when all of this are agreed upon at the management level, disseminating information about the decision and the plan of activities down to the branches will be very easy. So, as I said, very critical is the negotiation at the top management level.
Great. That's wonderful. Thank you so much for that. Very, very helpful. And we're still getting in quite a few. We're getting in quite a few questions, which is great. And I'm going to unmute Dennis. Dennis Kiemba, are you there? Dennis. Hi, Dennis. Okay.
Hi, I can
Hi.
hear you.
Great. I know that Cecilia wanted to you have gone through one of these loan process reviews, and I wanted to turn it over to Cecilia, who could get a little bit more information from you, on this. So Cecilia, did you have a specific question for Dennis?
Yeah. Hi, Dennis. Good to see you in the webinar. Now,
Thank you.
Dennis, I know that in the institution where you used to work, you have done quite a number of, you have experienced quite a number of loan process reviews done by your TA partner. Now, could you possibly share with our participants the key benefit the institution has gained from the loan process reviews?
Okay, thank you, Cecile. Hi, everyone.
Dennis, it's a little loud. If you want to just step back a little from your microphone.
Okay.
Perfect. Much better. Thank you.
Is that better?
Much better. Thank you.
Okay. So, before getting into consultancy, 22 years ago, I was involved in implementing a cash flow-based lending project with my former employer. That was a microfinance bank. And when we started the project, that was in 1993, everything was from scratch. So we were the first team to be trained on the cash flow-based lending. And we ran with the processes and the new methodology. It was individual lending for around 1.5 years. And of course, it was exciting with some expansions and more staff being brought on board. We had to incorporate the old stuff from the old methodology. And as time went on, the portfolio started to get a little bit bad. We had a decentralized approval system where branches were approving loans, and some of the higher level limits could be forwarded to head office. So what we did then, because we had a very good MIS that we could get all the reports, the whole performance could be triggered by the quality of the portfolio through the reports. So we decided to take an in-depth analysis of the figures, both vertical and horizontal analysis, using the bucket of the portfolio, using the aging, using the loan tenor, using the collateral type, all dimensions. And we discovered very critical things that needed very quick action, and that's when we went into deep diving into testing the different processes in the field. So we had to go into the field, check all loan files, engage staff at the branches, and even engage customers in the field. Then there was a very big revelation about the kind of changes that we had to make. Some of the changes were related to structures, where we had to change the way we are approving our loans. We had to adopt performance-based approval levels, where people were having good appraisal and good portfolio quality. We had to award them better approval limits or higher approval limits, and those that were not performing, we gave them lower limits until they improved. We had to introduce a number of processes like monitoring and supervision of the portfolio from head office to branches, it used not to be very strong. We had to strengthen it. And then from customer perspective, we had to introduce quite some carrot and stick measures. That's the time when we introduced things like a checking system where customers had to sign checks, so that could ease the way we follow up with the recovery in the field. And we had to review a lot of processes to improve on the turnaround time. So the whole exercise was a big opener, and from that time going forward, almost every quarter and 6 months, we had to take some detailed analysis to see trends in what was happening in the portfolio. And that trend analysis really can give you a lot of information about what is happening in the portfolio and the kind of direction you can take in case you see some consistency in certain trends. So it was quite a good exercise, and even to date, that institution is still doing a lot of those portfolio reviews, and they have assisted them to really maintain a very good portfolio. At the same time, supported them to rapidly grow the institution.
Great.
And that's what I had to share.
Dennis, thank you so much for that. That's very, very helpful, and it sounds like it was a good exercise for your institution. I'm going to keep moving forward. I'm going to put you on mute, Dennis. Thank you. Cecilia, did you have any comments about that before we move into some of the other questions?
Yeah, one thing that I'd like to highlight from Dennis's experience was that they went on with the expansion of a new approach in loan appraisal. That was the cash flow based lending. Now, take note that Dennis said that after it was pilot tested, it was rolled out, and there was no review done in between. Not until portfolio started to misbehave. When PAR increased, that was when management decided to do an in-depth review. Now, we hope that that unfortunate experience won't happen in our institutions. As we emphasized, let us not wait for delinquency to spike before we do the loan process review. Loan process review is a very effective, proactive tool in managing our loan portfolio. Now, Jessica, if you can give me 1 more minute, there is one more experience that I wanted to share, which I think would be very useful for us here. And this is about our observation in one institution that was concerned about the high manpower turnover. Now, during the review, or before we started the review, management explained to us that their biggest concern was that over the years, they found out that good performers were resigning when they are assigned bigger responsibilities. Like, their practice was, if loan officers hit their targets for like 6 months, and if their portfolio quality was very good, they promote them to become supervisors. Some of them were promoted to branch managers. But they said the trend that they saw was that when they assume these higher responsibilities, their performance starts to decrease, and not long after they resign. So after during the review, we conducted a lot of interviews and focus group discussions to draw from these persons concerned what their issues were, what was causing the decline in their performance when they assume higher responsibilities. And apparently we found out that the institution was lacking in preparation for these guys to assume higher responsibilities. True, they had good technical skills, but supervision or managerial skills is a very different skill altogether. And for them to acquire that, they have to be given sufficient amount of training and mentoring, and they have to be given enough time to adjust to bigger responsibilities before they're asked to run in the field. So what we recommended was, instead of promoting or instead of giving high responsibilities to good performing loan officers, why don't you ask somebody from HR department to observe the good practices of these good performing loan officers and these good performing branch managers, and do a training and get them to share their secrets, their key success factors, and include this in the regular training of loan officers, both the new and the existing ones in the loan refresher trainings. So they pilot tested it. The good performing loan officers and branch managers were slowly promoted, still on the same post, like loan officers were designated as senior loan officers, and in due time they were given supervisory training, and branch managers who were good performing, they were designated as senior branch managers, and over time they were given good managerial skills development training, and that solved the problem. And the 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 managing director of that bank was very happy that we came up with such a recommendation. And I communicated with one of them after a couple of years, and I was happy to know that they have implemented a recommendation. And they said that since then, the dropout in the good performing loan officers and supervisors had decreased substantially. Staff retention has increased because of the proper way, the improvement in the way that they were handling promotions.
That's great. That's excellent news. And you know, we've got quite a few questions coming in, and we will get to all of the questions, whether or not they're in this discussion or through another format, whether or not it's in our LinkedIn group or, you know, in an email that we send out. But we've got a couple questions around technology. And I'm going to get to that after this first question, which I hope is a little bit shorter. But we have a few questions around timing. So when is the best timing to do a loan process review? And also, you had mentioned that the loan process review should be done once every 3 years. What would be an indicator that the loan process review should be done earlier than that? So just talking about the specific timing of executing one of these.
Thank you. Now, the findings of the loan process review are most useful when the institution is preparing for the strategic planning for the following year. Now, before setting targets, before planning for expansion or new product development for the coming years, for the next 2 to 3 years, it is very important that they look at what's going on in the existing operations. The good things that are happening, which can be very helpful in attaining the targets in the coming years. So I would say that the best timing to conduct loan process review under a normal scenario without any pressing problems, for example, would be during fall, because that's the time when banks are preparing for the strategic planning, which normally happens before the end of the year. So the output of the review could be a very good basis for them to set their targets. If they see, for example, pressing concerns that need to be addressed first, then they might decide not to be so ambitious in setting the targets for the first year and include some activities in order to address the the issues that were highlighted in the loan process review, so that in the next 2 years, for example, scaling up business would be smoother when the issues are being addressed. Now, as to some of the challenges, one of the key things that we normally encounter in setting the timing is that there are so many activities going on in banks, especially during the second half of the year. So what we would like to see first is, of course, the list of activities and the priorities. For example, if they have activities on month 3rd, 4th, and 5th, and if we can convince them that those activities can be moved a little bit farther in order to accommodate the loan process review, we can also suggest alternatives like we can do process review here and we would be needing this and this persons, and when this other activity kicks in, then we can do some substitution in the persons that we would be needing in order to complete the review. So in other words, some negotiations, some compromises in some areas that we can be that can be negotiated on, like the availability of persons. We always go to that extent just in order to help management get some very clear ideas as to how their operations is going on before they set their targets for the coming years.
Great, that's very helpful. I'm going to move to some of our technology questions now, and I'm going to unmute one of our partners, Frederico, who had a question about technology, and I'll let him ask that. So I'll go ahead and let Frederico ask his question, and then I'll add a little bit more to it as well. So Frederico, are you there?
Yes, I'm here. Hello. Good
Hi.
morning to everyone. Yes, my question was regarding the role of technology when it comes to the loan review process. I mean, I have seen in some institutions that it's important that this technology kind of make institutions design a better loan process and also to monitor this process better. I don't know if you have any experience on this.
And along with that, a second part is if it improves if technology could be used to improve the mechanics of the loan process review.
Exactly.
Or also to address some of the issues discovered by the LPR by forcing specific workflow and documentation processes. So that's a second part of it. So we've had a couple different questions on the technology and how technology or fintech solutions could improve this.
Okay. So far in the last loan process reviews that we have conducted, we have done most of the processes manually. Now, technology kicks in the analysis of the loan process flow if the loan process is also automated. Now, it would be very easy for us to do a paper trail, for example. If the progression of the process is already incorporated in the system. Now, in those cases, movements of files, for example, from the loan officer to the branch manager, from the branch manager to the credit analyst, are incorporated in the system. So for us, instead of physically following the paper trail, we look at the progression of the process flow in the system. Now, we review how things are working as they are integrated in the system. But so far, we don't have an automated system of executing the loan process review for now. Now, I'm very sure that some technology providers will be able to provide or to come up with a solution to help automate some of the steps in the loan process review. For one, the analysis of the portfolio, if there can be a standard spreadsheet that we can come up in order to make the portfolio analysis much, much faster. And also tracing the, what you call this, the performance trend of loan officers, how they've been performing, their productivity levels in the last 3 years, for example. We can come up with a software where we input the historical performance, the productivity performance of the loan officers in the historical period. Then that will be able to help a lot in speeding up the loan process review cycle.
Federico, did that answer your question, or were you thinking of another, type of technology for this?
I mean, I I agree with her in the sense that normal core bank.
I'm sorry.
I mean,
Keep
yes.
going.
Yeah, I agree that, I mean, most of the systems that I have seen so far in the banks that I work with, the core banking systems are not good for process management, let's say, for loan process review. So, screening the market for other solutions in terms of a software which could do this. I mean, this loan process review where you have, I mean, the loan process embedded within the system and the monitoring of the process also embedded within the system. I have not crossed many good solutions so far. And I think that the future of, when it comes to this loan process review is really to either develop yourself such software, which can be easily, interfaced with the core banking system of the institutions you are working with, or really, partner with a fintech or other technology providers in order to do so. Because really my experience is that when it's paper-based, it's very difficult to monitor that the process as designed is working. Yeah, and the second thing is that of course, I mean, when it's paper-based, you always find a corner to to really do your own process.
Yeah, this is very true.
That's interesting, and we do have a couple fintechs who are joining us today. So if they're listening, this might be the future of a new product line for them. So great, Federico, thank you very much for that. We appreciate it. We are running out of time. We are going to take one last question from a partner, and I'm just going to quickly unmute Joshua. Are you there, Joshua? Can you hear us?
Yeah, good morning. I can hear you.
Great. If you could just share what institution you're from, your name and what institution you're from.
Okay, my name is Joshua. I'm from Nigeria. I manage a microfinance institution in one of the villages in Nigeria, in the southwestern part of Nigeria.
Thank you.
So my question is, what advice will you give a small MFI with very little structure in achieving a good loan process review? Because in my institution, we've done quite, I think, a loan process review about twice, but not as in-depth as being initiated this morning. So I was just thinking that a small MFI like mine, what advice will you give to achieve a good loan process review?
Joshua?
Yeah.
How many branches does your MFI have at the moment?
One branch.
One branch. And how long have you been in operations?
We've been in operations for about 8 years now.
Uh-huh. And how many borrowers do you have?
As at the last count, as at May, we have close to 3,000 borrowers.
And you use individual or group lending?
Yes, we do group lending. We do group lending.
Okay. Now, if I understand your question right, you're asking for advice as to what type of or what approach of loan process review is appropriate for a small institution like yours. Am I correct?
Yes, you are.
Yeah. Now, I have experience doing what we call an abbreviated loan process review, which is very suited for small institutions like yours. Loan process reviews are always customized. We look at the scale of operations because then that will determine also the amount of time that we can spend. And what is very important here is for reviewers to understand what are the existing concerns in your operations. Now, being in operations for 8 years and with 3,000 customers, I'm sure you have come across a lot of good and not so good things in your operations as well. So as far as the approach is concerned, your loan process review has to be customized to suit the size, the scale of your operations, and the number or the level of concerns that you have that the loan process review would have to focus on. So our point is something can be done. We can customize something for institution. It won't be as extensive, or the process won't be as long as reviewing an MFI, for example, with 20 branches and with 10,000 customers. So just keep in mind that something can be customized for your institution if you are interested in doing a loan process review.
Okay. Okay. Thank you. I think I'll engage with you further after this.
Thank you.
Yeah,
Great. Thank you very much, Joshua. And we are out of time. We for questions, and so we'd like to get those answered either in our LinkedIn group, or we can also send those through in a type of email as well. And so again, I'd like to thank Cecilia very much for this. Cecilia has led quite a few loan process reviews for CapPlus, and so if this is something that you're interested in doing at your institution, please do get in touch with me or with Cecilia, and we would be happy to talk to you about some opportunities in terms of how to customize something for your institution. So thanks again to all of the participants, and thanks again to Cecilia for an excellent webinar.